Good evening, everyone, and welcome to my channel. This channel, we're on day one, and we are going to be discussing personal finance and investing tips, something that I am heavily interested in and currently do a lot of. I do a lot of investing, a lot of trying to better my finances, and in this video, I wanted to discuss something that I think is the most basic and easiest tool to create wealth and build your investment portfolio, and that is an index fund. And for those of you who don't know what an index fund is, some of you might know. It basically is an ETF which represents the S&P 500. An ETF is an exchange traded fund, basically something you can buy on Fidelity, TD Ameritrade, and it represents a group of different stocks. Instead of owning one stock, you own an entire group of stocks. So you might own, actually, I have it up right now on my screen. So the S&P 500 is a weighted cluster of stocks. So because Apple's the most the most valuable stock in the S&P 500, it's weighted 6.696% of the entire fund. Apple's and Microsoft is next. Amazon, Alphabet, which is Google, they're next. Tesla, Nvidia. So these are the top 10 companies, most valuable companies in the United States, and accordingly they represent the weight. So Apple is 6.7% of the S&P 500, Microsoft 5.93%, and all of these stocks, what an index fund is they take all of these stocks and is in one fund. So actually, let's look at what an index fund actually is. And this is the perfect example. This is what I invest in. It has low fees. You can buy this on Fidelity, TD Ameritrade. It's called IVV. What's so great about this is that, as you can see, on a 1 day, it might go up 1%. A 5 day, it did pretty well the last 5 days, but a month, 6 months, year to date, it's actually down 7%. The good thing about index funds is that if you invest over time, you can buy here, you can buy at the low, and your price will go up. So I'll show you what I mean by that later in the video. Now, like a 1 year, investing in especially index funds, they go up pretty high, down. They're all over the place. You cannot predict short term, but if you look at the long term, that's what you should care about. If you look since May 26, 2000, this fund was worth $137. 22 years later, it's worth $448. Now you might say, okay, that's about three and a half times as much. Okay, so 10,000 would be worth about 35,000. Well, it would be worth a little bit more because you'd also get about a 2 to 3% dividend on your investment. So I don't know the exact math off the top of my head, but probably between 500 600. So probably 20 years ago, that $10,000 that you would just have in the bank, you'd have in cash or whatever you'd be doing with it, probably be worth barely over $10,000, if not less, because you could have spent it. Would probably be worth about 50 to 60,000 right now. And that's the beauty of it, is that it always goes up over time because it's a basket of companies versus if you choose one company. If you choose just Apple, well, Apple is a great company to own. I actually own a little bit of Apple. I own more in the index fund, but the thing about it is, if something catastrophic was to happen to Apple and you had all your money in it, you'd lose all your savings because you just spent years investing in Apple, and overnight something drastically happened, and let's say it went down 50%, you'd lose. Index funds don't do that. Index funds might crash, but they always rebound as long as the history of the 100 years of the stock market. It's never, I think it's never had a losing track record for total of a 5-year period. So any 5-year period, it's always been positive. You can't say that about regular stocks. And that's what's so great about IVV. Now you might say, okay, I'm new to investing, or I do know what an index fund is, but how much can I make? Well, let's see. Let's say you had $0, and you just wanted to start doing $500 monthly. So you want to put your monthly contribution at $500. Let's say you wanted to do 30 years, and an estimated interest rate. Let's say it's a little higher than 10% because I think recently it's been high. The last like 40 years, it's actually been a little higher than 10%. So let's say 11%, and you want the interest to compound daily. Your number would be the $500 monthly, or $6,000 yearly, over 30 years. So would be worth $1.4 million. Now, $6,000 yearly over 30 years is only $180,000. So if you kept it in cash, you'd have $180,000 in savings. Now, why would anyone do that when over the long term they can make $1.4 million? This is enough to retire. $1.4 million. $180,000 is not enough to retire. And I say this as a young person. Even if you have 20 years left to retire, index fund investing is much better than bond investing, much better than pretty much even most stocks, because stocks you don't know what you're going to get. It's just a safer route. I actually have stocks. I actually have real estate as well, and I have stocks, real estate, and index funds. So I have all three. I have an IRA, a 401k, but we'll go into that on future videos about the type of different ways. But for now, I just want to explain to you the power of index funds. You can start here in your 401k, in your IRA, in your regular investment account. Probably the best option you can make. And Warren Buffett even said, and Warren Buffett, if you don't know, he's one of the most famous investors of all time. And he even said, he's probably one of the best and most famous, successful. He has a lot of stocks, but for a typical person who doesn't have access to all the information that big important hedge funds have, and big hedge funds have, and normal people like us, or very normal people, he even suggests investing in a low-cost index fund, which holds 500 of the largest companies. It has outperformed the market time and time again. Actually, I even think that there's been studies that show that index fund investing has beaten the actual stock market, has beaten funds who try and beat the actual stock market, because those funds, a lot of times they're investing in bonds or they charge you heavy fees. So index funds have low fees, and it's one of the safest investments you can possibly make. Now you want to see how you do year to year. As I was showing you before on that chart, here's more of an annual. So 2021 was a great year, 27% increase. 2022, we're off to a bad year, but with the turmoil that's going on in the markets right now, there's a lot of stuff happening with the Fed, the Russia, Ukraine. It's causing that. 2018 was down 6%. Again, this was actually during a time where they were raising rates. But 19, 20, and 21, look at that. The market was on fire since then. It closed at 2,500 in 2018. You would have almost doubled your money from 2,500 to 4,800, probably more, because I told you about the dividends that you receive. Again, you can see this throughout here. 2011, there was actually no change. The crash, so a lot of people got scared off in the financial crash of 2008, 2009, 2010. It bounced back. So this is just one of the best investments you can make. In future videos, I do want to discuss the different types of investment strategies and where to allocate this money, because yes, this is important investment, but it's where you should allocate it. But for now, this is what we're going to go through. And guys, that's it for today. So if you like this video, please hit that thumbs up and subscribe. Thanks. Bye.